If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you. Now back to the show.
Good morning, everybody. Welcome back to another live stream. Give me a second. I'll share my screen. Hope you guys are doing well. Today is CPI day, and it's probably, I would argue that CPI might be a little bit more interesting to markets this week than the jobs number even. Well, actually, I take that back. Because the jobs number was interesting, I think CPI becomes even more interesting. Here's why. So if we take a look at the jobs this week, what we could take away from that is that jobs were really strong. Like, we had a really upbeat job statistic, and overall yields moved higher, right? So, you know, initially, and then faded yesterday with the whole, you know, moves that we saw across the board yesterday. Dollar index did not really gain, though. That was the kind of interesting thing, is you did get, you know, rockstar solid jobs numbers, and dollar index moved slightly higher, not a whole lot of movement there. In fact, gold and silver kind of doing a decent job holding up their gains in the meantime. Stocks are selling off because they're having their own panic right now due to the whole AI disruption stuff. It is amazing, isn't it? Like, it's amazing how a couple months ago, everybody was shouting AI as a reason for stocks to go up. And now suddenly everybody is shouting AI for reasons that stocks are going down. It's fascinating how, you know, this is why when we talk about markets, there is an essence of human psychology in all of it, because narratives can shift so violently. Anyways, we've got a important topic here today. We've got the CPI report and what it means to markets, which can be a lot. So let's get into this. So I wanted to just do a little bit of a visual board here. It seems like these are helpful. When I talk about them, people seem to respond positively to it. So we'll do a little bit of a breakdown here on today's CPI print. So the expected value is going to be 2.5% year over year inflation through the CPI report. Okay. So in terms of how this impacts everything, I know a lot of people come in here, and maybe real quick, if you guys could just do me a quick favor, what are you guys watching most today? Are you watching stocks? So like indices, individual stocks? Are you watching gold? Are you watching the US dollar? Are you watching oil? Are you watching Bitcoin? Comment really quick. What market are you most interested in here today? I'll do my best to cover as much as we can with the 10 minutes that we've got here to prep for CPI. And then, of course, don't go anywhere, because after CPI drops, that's where the real fun begins. We actually can start talking about how we can use this and factor this into our analysis. Okay, we got gold, NASDAQ, indices, NQ, silver, gold, metals, Dow Jones. Okay, cool. So whether you trade for the indices, people, real quick, whether you trade Dow, S&P, NAS, it's all going to be kind of the same thing. I just put stocks as kind of a kind of unanimous, all of them, all included, right? USD. Okay, cool. So let's talk about it. What is a hot CPI report? Well, if you're new to fundamentals, these CPI events are very, very meaningful to actual economic data prints. Now, some people will dispute, oh, you know, they're faking it. It's CPI, all this and that. Pause that for just a second. It's kind of like I have this digital scale that I'm using right now because I'm trying to trying to take care of myself. I've got a scale that I'm using. It's one of those smart scales that will tell you all sorts of different, metrics about your physical health, right? It'll give you like your muscle growth over time, your bone mass, your overall weight, and all these different statistics. I was talking to Grok about it, the AI, and it said basically those things are not super accurate, but what's most important is direction. So when you're trying to improve your health, right, it's directionally, are you adding muscle mass? Not necessarily exactly how much muscle mass you have, but are you adding muscle mass? Or in this case, when I'm equating that to economic data, we can argue back and forth. No one's going to be able to prove it exactly right or disprove it on, how much or how little the government is doing whatever with the numbers. What matters more is simply the direction, right? Because I think CPI, you can if you want to claim that they can fudge the numbers and make things up, sure. But the general direction of inflation, et cetera, is something that we all see and feel. You can't completely fake the feel that you go out there in the world, and the direction of CPI is pretty apparent to all of us who are using any sort of monetary system, right? So again, take it for what you will, but to me, direction is most important. And so we are expecting CPI to come down today. If we do not get CPI coming down today, how does that impact everything in our charts? We would call that a hot CPI print, right? So if we have a hot CPI, meaning above 2.5%, it comes in high. What does that do to our charts? Well, stocks don't like that because that's going to discourage rate cuts. Gold doesn't like that because it's going to discourage rate cuts. USD is going to like that, right? Because it's going to discourage rate cuts. And oil is not necessarily going to like it. But I would say it's sort of an in between not liking it and being okay with it, because oil obviously rises. It's an industrial commodity. So generally speaking, though, let's keep it simple. Oil generally would prefer rate cuts, right? Because rate cuts stimulate economic growth and can cause demand for oil to rise. Pretty much flip all this around. Let's say we have a cool CPI print. We would consider this good news. If CPI was cool, let's say we got a 2.4% reading today or a 2.3% reading, how would markets generally react? Well, stocks would love that. Hey, we might get some rate cuts. Gold would love that. Hey, we might get some rate cuts. US dollar, not so hot, because of course, rate cuts are generally perceived as negative for the currency most of the time, especially in the short run. If we're talking about oil, oil price would like the idea of economic stimulus through rate cuts. Inflation, CPI readings, etc., you can kind of think about it as, how does this impact monetary policy? In fact, that's the easiest way, I think, to explain, because sometimes people hear inflation coming up and they hear gold going down. They're like, that makes no sense, right? Isn't it going to mean, or for example, they think high inflation, doesn't that mean you're printing a lot of dollars? So shouldn't that make the dollar go down? And I remember thinking that initially too. It was something that confused me for a while when I first got into fundamental analysis. But the reality is, it's not about necessarily the inflation looking back. It's about the interest rates going forward, right? So if the Fed sees high inflation, what does it do? It doesn't cut interest rates. It slows interest rate cuts. And if the inflation is cooling off, then the Fed says, okay, cool, we can cut rates. See what I'm saying? That is the theory here today as we go into this report. So whether you trade stocks, gold, USD, oil, etc., that is what we're working with. Let's do some quick technicals here as we have 5 minutes to go. By the way, everything that I just did, we have automated within our software, the EdgeFinder. So let me explain what you're looking at here. The EdgeFinder looks at all of these metrics: CPI, PPI, PCE, interest rates, NFP, unemployment, unemployment claims, ADP, JOLTS job numbers, consumer confidence, retail sales, both services and manufacturing PMIs, GDP growth quarter over quarter, crowd sentiment, commitment of traders report, seasonality and trend. It looks at all of these things with as much depth as I just did through explaining that, but it automates every aspect of it. So every single one of these metrics has as much complexity or as much breakdown as we just did, but we have automated the entire process and built a system that helps to spot top trade ideas based on that across economic growth statistics, inflation statistics, jobs market statistics, sentiment, and technicals. And the best part is this is free right now. Until the end of the week, the EdgeFinder is free access to everybody who is watching right now. I just want to drop that notice because, again, that is coming to a close. If you have hesitated on that, do not, because this is your last chance to try it completely for free with full access unlocked. So if you're interested in doing that, we'll drop a link here in live stream chat right now to where you can request access to the free version or the free access period that we are doing this week. So if that's something you're interested in, you can scan the QR code below my camera right here, if that's easier for you, or simply click the link being dropped. Used the free EdgeFinder yesterday. It was very interesting. Yeah, it's I mean, it's a lot of tools, a lot of data. If you're looking to implement technicals, fundamentals, and sentiment into your trading, then consider checking it out for free this week during our event. Okay, so gold here on a technical basis, I'm looking at the 4-hour time frame. A little range bound here. We did have a big drop yesterday in precious metals. We've rebounded a little bit here. You're up 0.89% here on gold, and silver, meanwhile, up 2.5%. So silver was a rough day yesterday for metals across the board, but silver especially took a big hit. So if you get a CPI print, as we discussed, if you get a cool CPI print, gold could potentially break through these levels. If you get technical price action above this with some solid closure today, you could perhaps see a continued rally into next week. However, we did have the really strong jobs data, and we almost had like a delayed response to it. 24 hours later, gold dropped hard. It was also some housing stuff that went on. I thought that was kind of interesting yesterday. That was a big mover in markets. Really poor housing numbers caused yields to drop yesterday, which you would have thought would have given a little bit of reprieve to gold, but not enough, it seems. Anyways, watch for a break. I think you're stuck in a range right now in gold. Watch for a break below this area or a break above this area. I think those are going to be your critical levels if you're watching the 4-hour time frame. If you're watching the 1-hour time frame for gold, then you have, something a little bit more local, this 4,900, but also this 4,940 today. If you can close really solidly below that, let's say you get a candle closure here, that could potentially signal that we may be headed a little bit lower here in the short run, following through from that big yesterday drop that we did see. We've got about 30 seconds to go here, so I'm going to go ahead and switch over. Don't go anywhere after the numbers drop. Just reminder that once the data actually drops, we'll interpret it, and we'll talk about how it actually could impact or not impact follow through on a lot of charts. So yeah, we got about 20 seconds to go. We got core CPI and CPI year over year both coming out here in just about 10 seconds. I've opened up our all markets view so that we can watch all of this at once. So you've got NASDAQ and S&P, gold and silver, oil, dollar, Bitcoin, Dow Jones. Data should drop any second now. Okay, dollar is initially dropping here a little bit. Nothing too remarkable. Dollar index is moving lower. Gold and silver remaining pretty unchanged. Okay, CPI month over month did come in at 0.2%. And there it is. CPI year over year came in at 2.4%. That is a cooler than expected print. And not going to lie, that's a pretty good setup this week if we think about how this impacts things. You have strong jobs numbers and cooling inflation. That's a dynamic that is not too shabby and honestly is a pretty good setup for stocks, I would say. Obviously stocks have their own issues right now with the whole, software disruption story going on and the narrative around that kind of spooking investors. But that is a very solid setup here for stocks, right? This week, let's think about it. Jobs data was strong. Inflation was soft. That's great for a stock market potential bump. And maybe we'll see a little bit of a turnaround here today. Again, the narrative around software, though, is something that this is where sometimes, in my opinion, you just bow down to what price action is telling you. And so I think that this is actually a great setup this week in terms of the data for stocks. I would say stocks actually took the win here in terms of how the data fell, because let's think about this. Stocks got a double check mark this week. Jobs data, right? So, but the problem is, again, I'll get to the narrative in just a second. Okay, let's talk about this for stocks. Okay, jobs data, smash hit. But then people are worried, oh, well, that's going to cause inflation, and then the Fed's not going to cut rates. Well, then we just got confirmed data that we've been expecting, actually, from the true inflation stuff, cooler than expected inflation. This was a smash hit win for stocks this week. However, as I discussed, the narrative around stocks is dislodged, I think, from some of the standard economic data right now. Because again, you have this narrative around software that we've been covering quite a bit on the channel. And actually, it's not necessarily that stocks are doing terrible. It's just that certain areas are doing really bad. Like if you take a look at like technology, technology is getting hit, right? Software's taking a hit. We take a look at the IGV. But meanwhile, you also have some exciting stuff going on in like energy stocks and consumer stocks, right? Take a look at this. I mean, these ones are doing excellent. So you have this changing of the guard almost going on right now. Anyways, how does this impact gold? Well, CPI coming in soft, that's great for precious metals. However, I would say that we go back to that comparison of this week's data. And by the way, all of this will automatically be filtered into EdgeFinder's scoring, what I'm telling you right now. But from a manual basis, we could just say this. Jobs data, really strong. That's bearish for gold. Inflation data, cool. That's good for gold. So kind of a mixed bag. Same with the dollar, right? Well, actually, I'm sorry. Dollar, same story. Jobs data, great. Inflation data, cool. How does it impact dollar? That's neutral, right? The winner this week, I would say, is two things. Oil looks real sweet after this. I am long oil, by the way. I took a small long position yesterday towards the end of the day inside of our Discord group. So I'm still long oil. And I think that this trade, this was a sweet spot, I would say, for oil. Of course, anything can happen in the short run. That's why we use stop losses. But I think you have a nice setup here for oil and energy stocks in general. Inflation cooling, jobs data strengthening, a rotation trade into more industrial type stuff. I like oil. I have a stop below. If it doesn't work, it doesn't work. But with that said, I'm going to bring in my friend Chris Pulver to take a look at markets here with me and react a little bit to this CPI print that we just had. Again, good expected CPI. Hey, Chris, how you doing, man?
What's happening? Happy Friday.
Happy Friday. Hey, so kind of, I was going through this, but kind of a sweet spot for equities and certain commodities this week, right? Cooler inflation. And you kind of forewarned this with the whole trueflation thing, right? We've been seeing trueflation come down, and here's your CPI print coming softer than expected.
Yeah, I mean, unfortunately, it's coming in when we're at a low point for the week. So I'm not sure if this is going to be price action that kind of saves the week, or if it's, hey, it's improving, but what does it mean overall? Is it enough to get like the big bounce back like we saw last Friday? Probably not. I would think probably not. But anyway, it's encouraging. I mean, it's certainly better than having, questionable job data and also having higher inflation, stickier inflation. So it's been coming down. It's just, I think it's the pace that if you're going to spin this in something negative, it's the pace that inflation's been showing the downside. But nevertheless, I'm still looking to get some trades in efficiency wise. Yesterday was a good day in futures to the downside. It ran all day, finished at lows yesterday. So we're getting a little bit of pop up here, which is nice this morning. We'll keep an eye on things.
Yeah. And then I think, again, the way I've kind of looked at it this week is if you take the two big reports this week, there were other ones, of course, but let's just take NFP and CPI. I kind of was making the case that I think it was a sweet spot for equities and oil. But I'll say, I really like oil here. And I sent you that message yesterday. My concerns with equities, which are you're seeing this this narrative take root in equities that is really fierce. Like I think that judgment from my side is that long term a lot of the stuff that's getting sold really hard is actually on sale. Again, not financial advice. Please be careful in the audience. I'm not telling you what to do with your account. But in my opinion, some of this stuff in software is getting overblown, as we saw with like Ozempic stuff and a lot of the consumer staples that are rallying right now. Like last year when the Ozempic stuff was front and center, people are never going to buy Coca-Colas or Hershey's bars again. And those companies are rallying hard, right? So be careful with the narrative that, software is useless and everybody can just, write a quick prompt in ChatGPT and then they don't need a software company anymore. I think that is a little extreme one way. And so my thought process, and I sent you this message yesterday, but I'll share with the audience. My concern is that in the short run, I think that could cause a little bit more panic selling as people kind of flush out that risk that they're worried about. But longer term, I think it's a potential buy the dip opportunity. But one of the narratives that I've also seen floating around is that, okay, well, yeah, but the market's going to hold up fine because they're just going to rotate into energy and oil. But the message that I sent you yesterday was kind of highlighting that I don't know that that's enough conviction for people to put the same kind of buying power behind as they did with software, where there's these huge profit margins. And for the last 5, 10, 15 years, that's been a no-brainer winning trade, is to buy software where you have massive growth, massive earnings potential, profit margins, etc. And I just don't know that investors will look at that, oil and natural and gas and consumer staples with the same appetite to deploy capital. Does that make sense? Am I hitting that right? I don't know.
Yeah, that makes perfect sense. It's what's been the easiest trade of the last decade, Mag said.
Mm-hmm.
I mean, so people look at that, where is everything on sale tech wise? They've been the companies that have literally led the portfolio race for over a decade.
Right.
We've called them FANG. We've called them FANG Man. They're Mag 7. It's the magnificent, the Elite 8, the top 10, the $1 trillion companies, like whatever you want to call them. Look, they're still good companies. I think it's just, this is what the market gets swept up in, is the sentiment. It's like they're attached to this AI disruption. And even though they're still fundamentally extremely strong companies and software is extremely profitable companies, it's swept up in this narrative that there's going to be massive disruption. And I mean, I see this stuff every day online. I mean, DeepSeek is not going away. In fact, like, things will continue to evolve from that standpoint. So we'll see. I mean, look, we sit here and have this conversation. Like, I don't want to sit here and speculate like I know the future, because that's impossible. But I'm curious how this week ends. I'm curious how today ends. I think that today is going to be, if anything, an efficiency day, because yesterday was so far out. Like, I look at this stuff. I kind of do my math every morning. S&P was expected to do about a 39-point move yesterday, and obviously that didn't happen. So let me bring up another workspace here. Let's go this guy. So we dropped, I mean, even finishing the day lower, we opened up a little bit higher. We had a nice little follow through. So these black lines on my chart, these are still the big key levels that I'm watching. So even though it's a slide type day yesterday, and it was, very inefficient and from a day-to-day basis, we're still not doing any real technical damage of the last like 10, 11 weeks of indecision. So and that's what's annoying, is this market can have, I mean, a flush in 2 days, Nick. We went down, 2.4% in 2 days, and yet it really hasn't changed anything. It's still the same sideways choppy market. It just happened to be, same conversation we had here, down for the week, and then one big save on Friday, down for the week. What happens today? I don't think we're going to repeat Friday. That was a wild day, and I couldn't believe how much upside it actually had in one day with no real major catalyst. I mean, correct me if I'm wrong, but was there a reason that the market was excessively high on Friday? I mean, was it
not
avoid government shutdown? No, it's like, I don't know what exactly pushed that up. So
yeah, I don't really either. And again, to your point, Chris, I mean, if I look at like the weekly time frame for S&P 500, this is my other thing, is like, I'm looking around and I'm like, okay, I think software's starting to produce some deals, but then I also catch myself just thinking, this thing has been on a wonderful run, and on the weekly time frame, we don't even look oversold, right? So,
Right.
if I'm looking at this, I'm thinking conservatively speaking, I think that we could give back some of these gains if this narrative takes root, right? Like, and we know how fast narratives, right? This is a narrative right here. Like, this move was a narrative 101. People made the massive narrative shift to say that tariffs were going to cause massive inflation and that the store prices were going to skyrocket. And they just didn't. And again, not to say that, there wasn't a possibility of that happening. It's just that this is what people do in the markets is they take a narrative and they take a possibility and they treat it like it's a fact that's going to happen tomorrow. And so this is where, if you're a patient trader, a patient investor, that's where you want to see those types of moves. You want to see the narrative get extreme. So to me, it's like if the software panic can continue to roar for a little bit, meaning, expands to other industries and we start doing the domino effect where everybody's like, what's next? Like yesterday, there was a bunch of trucking companies that sold off because there was some AI efficiency thing that reduced potential demand for trucking in certain ways. And I from a investor's perspective, I like to see a narrative like that take place because it produces opportunities where people oversell. I think a lot of the stuff that is actually great companies that will do just fine in the longer run.
Right.
But of course, we can't rule out the possibility that AI is going to disrupt a lot of those things. So there's probably some truth to it, but I love when that, dislocation starts to happen where you start to see stuff sell off. I also think it's just a healthy thing for stocks to pull back. And so, I'm not short. I'm not, betting against it. I still have positions that I like for the long term, but I'd like to actually pick up some Mag 7 type stuff if it were to sell off for a couple weeks.
Yeah, there's buying opportunities left and right. There'll be buying opportunities. I think whatever I decide to buy, I've got to be willing to hang on to it. The one thing I'm looking at a lot, Nick, here's an interesting trade. Let's say here's the trade I was looking at yesterday. Now, the exact fill is going to depend on the timing of this, but I was looking at a trade where if I did, so we've had a pretty clear top at 7,000. So if I did a 7,000 sell put and I do a, let's say 6,100, no, 6010 buy put. Well, I'll just do this. I'll just 6,000. Keep it easy. Buy put. So that's 1,000 points wide. And let's say that I could do 995 credit. Okay. Now to explain this trade, I would be risking $500 to make 10 grand on the trade. So it's trades like this that I'm looking at for options where if the market were to come down, this area, and I can get somewhat of a fill that resembles this for such a, low risk, high reward trade, what I'm eliminating is all the noise. And over the time that I select, as long as price can stay above this 6,000 handle, I don't need it to go all the way back to 7,000. This could be a cash settled trade on S&P with SPX. So if we just bounce here and head back up, let's say we get back to like 6,500, that's $5,000 on my trade, only risking $500. If we got back above 7,000, I cap my upside, but I'd still be looking at almost 10 grand. So it's trades like that where I'm like, that's kind of how I'm gonna, if I'm gonna call the bottom, I'm gonna do it with that type of asymmetry, or you could also get long synthetically. So I'm saying all this because this is stuff I'm thinking about, where as somebody that's going to be watching these markets and trying to be opportunistic, right now the VIX is high enough that I want to just sell premium, and I'm going to sell premium using April lows. I'll probably throw another few pull alerts in between DIA, IWM, SPY Qs. SPY's been an easy one. I'll probably do SPY again, just because I don't ever mind owning at least a chunk of shares on the SPY.
Yeah.
But VIX is at 20 plus. Could it get worse here in the near term? Maybe. If we are going to break 6750, head down to 6500 or so, the VIX probably makes its way up into the high 20s, maybe even 30 plus. Are you still long the VIX at all right now, Nick?
Nope. I've actually been kind of on the same wavelength of looking for opportunities to sell premium on the VIX,
Okay.
or not necessarily on the VIX, but on some of the names that I'm watching. And Chris, I just wanted to also real quick, and then I want to come right back to you on that because you were talking about the S&P 500. Just an update on the overall data that came in here this week. I know I spoke kind of. I broke it down in a simple table, but this is the perk of EdgeFinder, is the utility of it automates that component. So CPI here today gives us a bullish reading on S&P. We know that, right? We discussed that. It's pretty obvious. 2.4%. Hey, that's a positive beat. That's good inflation statistics. Surprise to the downside is good on inflation for stocks and consumers. Then we can also kind of extrapolate that out to something else that we saw this week. We had a bullish NFP report. Unemployment rate also at just 4.3 versus 4.4 expected. We had 130,000 jobs added compared to 66. This was actually, as I mentioned earlier, I wanted to help visualize this. This was a sweet spot for equities this week. However, as I discussed, the narrative that we keep talking about here is, in the short run, kind of a deterrent to stocks. There's another thing that's working actively behind the scenes quietly on this, Chris. We are in that seasonality period that is not so hot for stocks. This is the time of year, at least historically speaking, going back to like the 1950s. If you're going to see a flush, obviously it can happen any month, but historically, this is around the time where you get seasonal weakness in S&P 500. So we have some forces working in our favor, but we have some things working against us. And so, you have that 4-hour and daily chart flip to the downside. I think that's a little bit more clear on the 4-hour chart, but a little bit of softness. And EdgeFinder here, if we take a look at some of the recent readings, has been poking into the bearish territory for S&P the last last 2 weeks, let's call it. So I remain a little bit cautious, not really willing to short this market unless, as you did a good job describing, Chris, we really haven't seen that technical damage be done. So for me to get short or to have a true bearish bias on a short-term technical basis, I'd be looking for like this break of structure here with a solid EdgeFinder bearish reading. I just want to add that context. And by the way, what that could do to the VIX is it could produce even more opportunities for us, Chris, on the short premium side.
Yeah, I mean, if you take a look, you've got the screen there. Go to like 2022 VIX.
Yeah.
Because if we see that type of VIX behavior, then we're probably going to have some additional deleveraging. And that was like a consistent like 20 to 40, 20 to 40, 20 to 40 for 9 or 10 months. So that was all 2022, lower highs, lower lows. I mean, if we're about to break some major structure technically, we probably do get a run into the 30s VIX. And then if it resets to 20 back into the high 30s again, then we probably have a couple of legs lower. But look, I'm still a buyer. I think you're going to see some vocal everything from the administration. I think Trump will be very vocal about what's going on in the stock market. Who's going to be to blame if something is wrong or something is down. But I think it's going to become kind of populism, where it's like, what can we do to make everyone feel better? Here's a stimulus.
Yeah.
Here's a program. Here's an incentive.
Speaking of
major buy levels would be 6,000, 5,600, 5,500. I think those are major buy levels, which is why I said this, a couple weeks ago, that a lot of my focus trades as far as selling premium is just way out of the way, below April 2025 lows, and just try to collect as much, safe premiums I can this year, and obviously use those dip opportunities for, better near-term trades and just better positioning.
What's interesting, Chris, is, we talked this week about obviously the concern, the disruption in the AI side and the S&P 500. But I feel like just from our conversations, we talked a lot about fiscal policy being very spendy across a lot of major nations, major economies. And I just, in our conversations, you've leaned into watching really close gold and silver, potentially allocating a little bit more to that. I'm curious. Well, I mean, I know your thought process, but for the listener, for the viewer, what has shifted you to wanting to allocate a little bit more to gold and silver, as opposed to equities here?
Well, like we talked about yesterday, I just think that so many signs point to gold as a long-term runner. I mean, whether it's the debasement, whether it's the fiat, whether it's the money printing, which is in excess, and it has been for decades, but now it's like the whole world's kind of catching on to the game. If you can't really grow your way out of it, you will print your way out of it. And at some point that does end with some really horrendous cycles. And like we talked about yesterday, it's like the Bank of Japan and the US, I do think, are in cahoots to try to get something salvageable with like not letting the markets go down. Nikkei's at all-time highs, trying to keep the S&P in the US markets at all-time highs, while each one could face, you know, currency disruption, but their bond market is going to be the most important thing. If we have a bond market flinching, that's not a good sign for the US. So here's bond futures right here. And we are, you know, off the lows a decent amount. I mean, this is still, I mean, one could argue it's like Buffett's been a net seller since 2024. So, I mean, some people are sitting on the sidelines. It's not unreasonable to be like, you know what? I don't want the equity risk. Here's 3.5% to 4%. I mean, your yield is 3.78 across the board on most of your bond instruments. If you look at IEF and TLT and SHY, all of them are showing like almost, I think, 3.75, 3.8%. Here's TLT. And, you know, and the arguments being made is like, nobody should have bond exposure. We should go to a 60-20-20. Look, I talked about that all-weather portfolio. I kind of like that idea of like, you know what, if we're going to have some wild and crazy crap happening in the next 12 to 24 months, I don't want to be on the hook for something like overexposure. I'm not leveraged. I don't trade with leverage, but like overexposed where, you know, we have a sideways or a down year and it's like every percentage down the market goes, so does my portfolio. I don't want to be that trader, you know? So having an all-weather portfolio is, I think, smart, especially for me handling accounts. You know, do I want cash? Well, sure, but not necessarily cash bonds. I want cash and like give me a, you know, like it's BIL, which is a short-term treasury mix, and this is a percentage. So BIL,
I do the S-Gov.
Yeah, S-Gov and BIL. So on this here, I mean, this is what it costs. Basically, you can see all these. This is not really a chart, but by the time it hits its 30-day maturity, you're getting kind of that par at the end of the month. So I've done this before where when I have cash allocated to this, you know, I might lose $5 to $10 on getting fully liquid because I can pull it out immediately if I don't let it go for like the full 30-day cycle. But this just stays in. You're getting about a 4% yield right now. Here's your 4.07. So to sit here and have unallocated cash getting you a little bit of a bump, that is risk-free. So that's not bad. I mean, risk-free at 4% is not bad. And with these valuations at, you know, 40 plus and Cape Shiller ratio and 25 times price to earnings, historically speaking, that doesn't look great. It doesn't mean I'm bearish. I mean, that's what's so silly. It's like, I just, and the underbelly of the market going down, like software and tech being deleveraged the way that it's been deleveraged, and the markets are clinging to like this 2 to 3% range. It just doesn't take much to break and go down 5 to 10%. And if it does, I'd rather be waiting for that to be an opportunity to buy versus hoping that the market just can't go down more than 2 or 3%. I mean, it's the, nobody wants it to go down, right? It's not fun to have the market go down, you know, have the VIX spike to 40 or 50. It's a huge event, but every time that has happened, there's typically a fantastic buying opportunity right there if you have the courage and the cash to do it. So unallocated cash comes out, I allocate. Selling premium when the VIX is high, that's pretty good profit potential. And obviously, like buying opportunities that I haven't been excited about might look a lot better, more attractive. So back to your question on gold, it's like a lot of things just point to having a decent allocation in gold. Silver is a bit more of the wild card. However, I think that silver, after showing us its potential, and we can't get enough of it, we can't produce enough of it. I just think that, well, we have a new target now, Nick. We have a target at 121 silver. If right now it's trading at 78 and I buy some at 78, there's good upside. If I buy it at 78 and 58 and 48 and 38, well, if it ever gets back to 120, ever, it's a great trade. So it's not a
Chris,
all in on silver.
Here's a question for you.
Yeah.
Do you, and I guess I have two questions for you on the metals.
Okay.
First question is maybe the more fun one. Is it worth looking at the miners or choosing to stick with the commodity itself? I feel like I haven't heard you talk a lot about gold miners or silver miners before. I know a lot of listeners, they'll get into GDX, for example. And the theory here, guys, is if you're not familiar with this, this is an ETF that tracks a bunch of gold mining companies, right? So gold mining companies have a unique situation in which if they own plots of land that they are mining on and the value of gold skyrockets, but they purchase the land at much lower cost, there's like this theory that, hey, they could extrapolate a lot of gained value. And especially with inflation chilling out here a little bit, their cost, big input cost for them is the price of oil and inflation in general. And both of those are relatively docile, I would say. So the question is there any added benefit in your mind to trading the miners over the actual metal itself, or would you stay more partial to sticking with metal?
I think if you want to be active and rotate, you can incorporate the miners, but it's not my space. I don't want to have to play the in and out game. I think if I just dollar cost average and build a portfolio allocation, I'd rather just be in the metals itself. Gold, silver's fine. Copper liquidity has been a little crappier after a disruption last year. We had like that 20% week to the downside. I'm like, all right, I don't want to trade copper anymore. There's just too much potential disruption there. So I've got exposure. I mean, my copper trades, FCX, Freeport McMoran, I've been long them since low 30s. That's been a pretty good position. Obviously, I was looking at this big range. Once we broke to the upside, I mean, I've been long at 30, 35 with some covered calls and some bull puts that bring my cost basis lower. Got some naked puts between 40 and 30. All those looking pretty solid. But again, that's not a copper play. It's like HG is copper futures, and you can see it's, way up here towards 6.5. I mean, look at the range. We have some intermediate lows that are trending higher. We have a massive channel that's all the way down to $3. I don't know if copper gets back to $3. If it does, I think it's back the truck up and load it up on copper again. There's ways to trade it. So, the stuff with the metals is, I'm a little bit price insensitive now that we've had a pullback. So as long as I get my allocation built back up, I think for the next 2, 3, 5, 10 years, I wouldn't really worry about it. And now that all the excitement's kind of out of gold and out of silver for now, things kind of calm down, cool down. Maybe it just becomes less of a talking point. But
sure,
central banks or governments essentially have a net long gold, have continued to be net long gold. Our biggest banks, JP Morgan and Goldman Sachs, are net long gold. That's usually a pretty good sign that there's a natural bid. There's a natural bid in the market, and I'm going to continue to ride that. And it may not be exciting, but that's my trading. It's like, it's not very glamorous. It's like, I just want to trade and make money. And I think that's a pretty safe way to have, let's say 10, 15, 20% between gold and silver. I told you yesterday in Discord, I'm like, even if I just bought, my chunk of shares and I use half of them, sell a bunch of covered calls and collect. I mean, what is a call right now? If I went out 12 months on GLD,
it's probably dropped a little bit, Chris, just because vol has dropped off on metals here, at least recently.
Yeah.
But yeah, I mean, you may be going out that long term could be interesting. Also, while you're looking at that, I just
get
want
about a 10%. You're getting just over 10%. So if I just bought right now, get a 10% premium, it's like, okay, so if gold get back to highs could be great, but it's like even landing a quick 10% or just lowering your cost basis, that's not bad either. We already had a bit of a discount, lower it by another 10%. If it gets called away, great, but keep a chunk that's covered and trading options, and then keep a chunk that's going to run uncovered and hopefully free to make new highs.
Yeah, Chris. So for the listeners, Chris is talking about an options strategy on gold. So not only just buying and selling gold through futures contracts, CFDs, etc., but rather you have multiple options. It's in the name with trading options. So for example, he could be long gold right here and then sell calls, which would cap his upside. However, it would create income for him on that position. But then at the same time, Chris, I know you've also talked about selling out of the money puts, so you could collect premium on the downside, collect premium on the upside, and just kind of move and flow with what the market's doing. We've got to pass the show over to our next host. I just wanted to also real quick, give traders who are watching gold here today a couple things to think about from a technical perspective. This week has been kind of a neutral read in terms of fundamentals, in my personal view. With CPI cool, that's good for gold. With jobs data hot, that's weak for gold, right? So you kind of get this mixed bag. From a technical perspective, I'd watch the breakout above 5,100 if bulls are going to take it. And for bears, you've got two levels. This 4,900 level to the downside could get us down to the low end of this, past few weeks. But I'd say, you need to probably see a break beneath 47.50 for sellers to really get something going here and maybe take us back down to the lows. Pretty neutral for me, so I don't really have a big decisive directional call on gold. However, to go alongside Chris's point, we've also been talking thematically on this show pretty consistently about longer term levels to watch. I know, Chris, you talked about, maybe selling some premium out on precious metals, or if you're just a simple, dollar cost averaging type of guy or girl, one thing to think about on gold, you've got a couple moving averages here on a longer term basis. This 50-day moving average comes in nicely around 4,700 currently. Let's see if we get a flush down to that level. If you're longer term in nature, maybe you're watching that spot. And then you've got even more if you're the type of person like Chris and myself from a longer term basis, you may choose to, watch this 100-day moving average and the 200-day moving average. And hey, maybe we're in the process of the next 3 months of retesting these moving averages. And that gives, patient traders or investors, depending on your time frame and swing trading or whatever, may give us a chance to watch it close. So gold is really interesting this year. I'm with you, Chris. I think it is something to watch on a longer term basis. I think we did have a little bit of a melt off top, but now we can actually be constructive as active traders and investors to see what we can do with it next. Chris, we've run out of time here. Got to pass the show over to our next host. Thanks very much for coming on. I know you were on a bunch this week, and great commentary this week, I think, for the viewers. So thanks for being here, man.
Of course, man. Have a good weekend.
You too. Okay, guys, up next, we've got Marco from Marco's Trading Journey. He's going to be taking over the stream, and he's also, I think, maybe he usually does, he's going to be doing a giveaway here for DNA-funded challenge accounts, completely free in the audience. So don't go anywhere on this. Before we pass over the show, just a reminder, if you want to try out the EdgeFinder, it's completely free to use over the weekend. That will be ending Sunday. So if you have not tried the EdgeFinder before and you're like, hey, I always see this guy using this tool in his videos, but I've never tried it myself. Usually it's not free to try. Usually it's, there's a lot of money that goes into building and maintaining these tools that we offer. But right now it's yours for free until the end of the weekend. So if you want to try it out, click the link right here. Up next, what we're going to do is we're going to throw the show over to, like I said, our trusted host here, Marco from Marco's Trading Journey. Stay tuned. He'll be in just a second. Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing, up to 90%, and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Hello everyone, welcome to my segment of the stream. We do have a giveaway today. I'm gonna put in the form. So this is the form. What you need to do is you need to go to the comment section, click the form, fill out the form, and then you'll enter into a DNA funded challenge giveaway. So for today, it's gonna be a 5K one phase account. I will do a giveaway in 10 to 15 minutes. The winner will get the code after my segment ends. I will email you with the code. Okay? So, getting started with the charts. I'm still in the Nikkei. It's still running some pretty good percentage. I have taken a short setup on the Euro Yen. I've taken it on Wednesday. Aussie dollar, I want to buy it, but I want to see a pullback. Gold, I want to get in, but I want to see a bullish EdgeFinder reading. So let's see if we go to gold. Bullish at the moment. Okay, we flipped back to bullish. Awesome. Let me just see if the CPI has been updated. Let's take a look. CPI. Let me check. If we go to the numbers, Friday CPI. Yep, should be updated. So here you can see the CPI. So the forecast was 2.5. Actual number was 2.4%, which means that is bullish for gold. So that gives us a bullish reading. I'm not gonna take a trade on a Friday because I just don't think this is the right time to be opening new positions. But next week on Monday, I will definitely consider taking a buy setup. We're even close to the 20 MA, which is great, as you can see right here. So the price is close to the 20 MA. So gold looking pretty nice, looking pretty interesting. The only problem I have is that that is Friday. Okay, let me also check something. The retail sales, or not the sales, but the retail sentiment has flipped from bearish to bullish. Okay, I'm gonna have to look into that a bit more. But again, inflation bullish, the NFP print came in bearish for gold. Kind of a mixed signal overall, kind of a mixed bag for the dollar as well. We got the NFP print, which was great. NFP print was pretty high. And now the inflation seems to be cooling a bit. I mean, overall, for the US economy, I would say that's pretty good, a pretty good sign. Good employment, inflation getting smaller or maybe getting under control. We can also go to the economic data, inflation, CPI, USD, and February 2026. So the trend is down. See? We can also look at Trueflation. I haven't been to this website in a while, but okay, I'm not sure how to get this number. Yeah, I haven't visited this website in a while. Anyway, inflation seems to be cooling a bit. From the stories I've been reading online from some good traders that I follow, like Andrew Campbell and Brent Donnelly, inflation seems to be falling in the United States. What does that mean? Well, it could open doors for more rate cuts. What is currently priced in for rate cuts? Has the pricing changed? We can, of course, bring it up. By the end of 2026, we have still 2 rate cuts of 25 basis points. But now going even lower I mean, this probability is going up for 3 rate cuts of 25 basis points. So 275 to 300, it's going up, which is interesting to see. So initial reaction, minimal. So minimal reaction. I mean, on the dollar, compared to the NFP candle, this is a pretty small candle and no real sustained move lower, which is interesting to see. Bitcoin catching a bit, but still being super bearish overall. DAX not doing anything. The DAX looks super bad, if I'm being honest. Russell, Dow Jones looks healthy. NASDAQ falling lower. S&P falling lower as well. Not a great story for the US stock market. This week hasn't been great, especially on the NASDAQ. I mean, we dropped. This was a big drop, and we are still stuck in this range. So still stuck in the flat range, still not doing anything. We can take a look at some big names. Google. Bearish. Good thing I didn't buy. So I was considering getting in on some possible buy setups on Google. Good thing I didn't do it because this looks pretty bearish. So this looks pretty bearish. I was looking to buy maybe at this level. I was betting on the outperformance of Google to most of the other AI names, most of the other technology stocks, and the NASDAQ as well. Seems like the whole technology stock market is being bearish. So it's selling off a bit. NVIDIA, Let's see. Just flat and corrective. Palantir. Whoa, Palantir actually super bearish. What about Tesla? No, not that one. Tesla. Flat. Tesla is flat as well. Microsoft and Meta. MSFT. Whoa, super bearish. Meta, I think it's gonna be bearish as well. Yeah, just not a great story for the US stock market as far as technology stocks go. My game plan is to look for all-time highs. So I won't touch Google, I won't touch the NAS until we can go above into all-time highs. Okay? By the way, just to remind the people that may have joined now, I will post a form in the comment section. Click the link, fill out the form, and you will enter into a DNA funded challenge giveaway. Okay? I'll take all of the names, put them in the wheel of names, and then we will see who is the winner. So make sure you fill it out. And by the way, I'm giving away codes, 1 code per live stream, pretty much every single live stream that I'm doing. And I'm streaming 5 days per week on the Trader Nick channel. You can catch my schedule on the A1 trading schedule, basically live stream schedule. So to go a bit deeper into my watch list before we start looking at comments. So by the way, in the comment section, also put in any requests that you have. If you want me to look at something, you find something interesting, you're looking to buy or sell something, put it in the comment section. And when I'm finished with the watch list, I'll go through the comments. I'm still betting on the buy Japan narrative. I'm still betting on money flowing into Japan and kind of going back to Japan, because you have to think about the money that was flowing out of Japan for the last few years. Now that the carry trade is unwinding again, now that the Bank of Japan is scheduled to raise interest rates, of course. Let me show you BOJ. This is the probability. Look, December 17th, 2026, from 0.75, you're supposed to go to 1.37. That is quite high. That erodes the profitability with the carry trade, and that brings money back to Japan, back into the yen, back into the Nikkei, or maybe more money into the Nikkei. What also helps is the current party, the current PM in Japan is super dovish. That should be bullish for the stock market, for the Nikkei stock market. My game plan is to keep a wide stop loss. I don't want to put my stop loss too close to the price because I want to give this trade some room to breathe. I think this could be a good one. We could pull back, let's say, a bit more, hit the 20 MA, possibly continue going higher. So I don't really want to choke the trade too much. And I don't really want to move the stop loss on a Friday, because on Monday we could gap down, we can gap up. And of course, the gaps can easily take out my stop loss. So I'm being careful. Essentially, that is what I'm saying. But 2 of my favorite trade ideas at the moment is going to be buy Aussie dollar and buy Japan. Okay. So buy Japan, this one right there, and then buy the yen. Okay. So essentially sell euro yen. Or I'm also considering maybe selling the dollar yen on pullbacks. So on rallies. So if we rally a bit, hit the 20 MA, could be a good opportunity to get in. This is all about the carry trade. This is all about the dovish government in Japan. This is all about the new policies that the new prime minister will implement, which gives us the buy Japan narrative. By the way, these trades were signals in the Discord. So if you want to get all of my positions, get all of these signals, catch these nice winners. So this one is a winner for sure because I've trailed the stop loss. This one we will see. It's still around break even. Okay, this one can gap down massively. So if we get this, then of course it's not going to be a winner. But I think the probabilities of a massive gap lower are small. essentially, if you want to get these signals, definitely consider joining the A1 Trading Discord. Link is in the description, and you can use the code Marco to get 25% off. This discount is for the Discord, works for the EdgeFinder as well. So if you want access to my trades and all of my knowledge and everything that's in my head, well, not everything, but trading stuff, join the A1 Trading Discord. Aussie dollar, love the idea. So love the Aussie dollar. I think it's going to continue being bullish. We're approaching the 20 MA, which is nice. I don't think a trade is going to happen on Friday, but maybe next week. You know, RBA hawkish. RBA should raise rates more. They should raise more rates in 2026. If we go to inflation, if we go to AUD, pretty high, you know, pretty high inflation in Australia. They can afford cutting, or they can afford hiking rates. I think their GDP is fine. Looking at the GDP, Aussie, yeah, it's fine. It's fine. You know, positive, much better than the UK. I think UK is struggling. Actually, UK looks all right in terms of GDP. Is it Canada that had what? Canada? Okay, the last print was negative. Which country was it that had bad numbers? It wasn't Europe. Well, New Zealand is kind of having some negative GDP numbers, but okay. Main point, Australia can raise rates. GDP looks all right. It's positive. Inflation is problematic, super high. I think employment is good as well. If we go to labor unemployment rate, we go to AUD. Yeah, it's fine. 4.1%. That's pretty low. So great trade idea. And if we hit the 20 MA, game on. Last thing to check, top setups. AUD USD. AUD USD bullish reading, which is awesome as well. Sluggy says, Marco, that was GBP, bad GDP. No, let me see. Did I miss something? GDP, Aussie. I mean, it's positive in Australia. That's what I meant. As far as GBP goes, as far as the UK goes, it's positive as well. You know, it's pretty low, but it's positive. At least it's not contracting. I know it's falling a bit. That you could make a case for that. But Aussie, it's okay. It's not really falling. We can go back, I don't know, let's go back 5 years. Can we do it? Okay, this was COVID and all of that. And the stimulus and stuff like that. But okay, massive inflation. It's fine. Fine. GDP is fine. Did I miss something, Sluggy? Definitely put it in the comment section. So gold, main goal is to get in. This level looks totally fine. Big uptrend. Fundamentals are bullish. I want to take a stab at it, but I just don't want to do it on a Friday. Kind of hesitant to do it on a Friday. Some things can happen over the weekend. I'll much rather wait for Monday. I don't think we're going to get a massive rally here either. So I don't think we're going to get a massive rally. And I need to check what is happening with the retail sales. So if we go to gold, the retail sales keep flip-flopping from bearish to bullish. So that's something I need to look into. Or not the sales, retail sentiment. So if we go to crowd sentiment, retail sentiment, we go to, let's say, the history. Let's go to gold. Okay. Yeah, unfortunately, this keeps on flip-flopping. So I'm gonna have to look into this a bit more. Giveaway time. Last chance to enter the giveaway. Link, I'm gonna post the link one more time. So there's a form. It's gonna be in the chat. Fill out the form. You'll enter the giveaway. You have a couple of seconds more. Okay, I'm gonna give you a minute more because it takes some time to fill out. What's next on my watch list? Pound Aussie. Like this one as well. If we go to the EdgeFinder, GBP AUD, bearish reading, which is always nice. Pound, I think it's a pretty weak currency. The UK is not doing well at the moment. The Aussie doing fine. UK is actually looking to cut rates, if I'm not mistaken, which is good. Let me tell you why. Yeah, next meeting pricing 71% chance for a rate cut, and current rate 3.75. We should finish 2026 at 3.21%. That means Bank of England is dovish, RBA is hawkish. Perfect divergence for the pound Aussie to go lower, right? And it is going lower. I just want to see a pullback. I just want to see a pullback to the 20 EMA. Okay? We have that 20 EMA. If we pull back into it, I'll most likely take a stab short on the pound Aussie. Now, time for the giveaway. I think I gave you enough time to fill it out. Today is the 13th of February. Okay, let's find all of the entries. Whoop. Copy the names. Wheel of names. Paste. In. Let's see. So, Christopher, yes, looks like the winner is Christopher S. After my segment, you can expect an email from me. I have your email information right here. So it's a 5K one-phase account. Congrats on being the winner, and good luck with the account. If you didn't win and you want to get funded with DNA, like I am trying right here, I was funded, but I lost the funded account. So this is my phase one. This is my 25K two-phase challenge. It's in phase one, and I'm in around $700 in profit. If you want to get funded with DNA, A1 Live gets you 25% off any DNA funded challenge. So this discount is specifically for you guys watching the streams. Usually it's 20%. Now it's 25% on the stream. So A1 Live, 25% off. Great prop firm, ran by professionals. There's a big broker behind it. So you know that they're not going to disappear in 3 to 6 months. They're going to be here for the long term. And the best part about it is it's a great prop firm, and you get a great price with this discount code. My current progress, just a second. My current progress, as you saw on the portal, is I'm in a little bit of profit. Took some losses, and this challenge is being purely traded by ChatGPT, if you're wondering. So this is just for my YouTube channel, nothing super serious, but ChatGPT is doing pretty well overall. I started the whole challenge with taking ChatGPT signals in July of 2025, and from that date to now, ChatGPT is up 35%, which is pretty nice. Time for the comments, because we still have around 5 more minutes left. So hello, welcome Sluggy, welcome non-rated trader. What's your bias on the DXY? That is a good question. On the DXY, well, we had some conflicting numbers. NFP ended up being, you can see it here, bullish for the USD. Inflation, let's look at the core CPI. Actually, let's look at the year-on-year CPI. it came out bearish for the dollar, right? Because the actual number lower than the forecast and much lower than the previous number. So inflation seems to be coming down. And I think it actually is coming down from the reading that I've done so far. We have found a nice level of support right there. But personally, I don't see a massive bullish or bearish catalyst on the horizon. Maybe a bearish one would be the buy Japan or the carry trade unwinding. You know, so carry trade unwind, we could get USDN going lower as it is at the moment. So USDN going lower, which means the dollar loses value, which means DXY drops, because yen is a huge part of the DXY basket, dollar yen. So that could be actually a case for the DXY dropping. Now, I don't have a lot of confidence in playing that and just shorting the dollar, because I think the carry trade is unwinding. I would much rather buy the yen and buy the Nikkei. But what I am doing is I'm buying actually the Aussie dollar, or looking to buy it. So I kind of am playing for the dollar weakness. Although this trade is more based on the strength for the Aussie and what the RBA is doing than actual DXY weakness. So you could say I'm playing short for the dollar, but just for the DXY, just by looking at the DXY, I don't have massive confidence that we're gonna drop or that we will explode higher. What makes sense to me is that we range. So I just believe we're gonna range until we get a big catalyst, until we get some news or some sort of a resolution or something with tariffs, Iran, Greenland, Europe, I don't know, Venezuela, okay, until maybe some uncertainty settles down around all of that, or until Trump settles down a bit. We'll have to see. Good question, though. The current situation, since the Feds are keen on focusing on their dual mandate and lately jobs data specifically, but since the recent jobs data was a beat, I don't see much reasons to cut. Well, that is I would say a good view, although I think they will cut by what is priced in. So we brought up the Fed Watch tool. By the end of 2026, 2 rate cuts of 25 basis points. I do think it's going to happen, at least 1 rate cut, but I think 2 can happen, especially if inflation is falling. And it is. Inflation is cooling. I have to admit that if we go to the EdgeFinder, we go to inflation, CPI, USD, cooling, right? Definite downtrend on the inflation part. Powell is a sitting duck, or a lame duck, or whatever the expression is. So Powell, whatever Powell says, has no weight. We need the new guy to come in. We need Warsh to come in. Most likely he's going to be the new guy. And we'll see what Warsh has to say. Maybe Warsh will give us some clear guidance. Maybe he will say, we're planning on 2 rate cuts. We're planning on 3 rate cuts. We're planning on no rate cuts. Although because he has been nominated by Trump, I think he's going to do rate cuts just to respect the nomination. It would kind of be a slap in the face if Trump nominated Warsh and then Warsh does 0 rate cuts because Trump wants massive rate cuts. Okay, so that's my opinion. Inflation coming down is also Goldilocks zone so far. It kind of is for the latest print. You know, good NFP, low inflation. That's pretty good. Goldilocks, if I'm not mistaken. Isn't the cut already priced in? Possibly. It is. It kind of should be priced in if you're looking at just the DXY. That's why I'm saying that the DXY won't go anywhere specific. It'll just range around, because I do believe rate cuts are priced in. That's why I think we need another sort of catalyst for the DXY to move. Okay, that's it for my segment. You have Forex James coming up. Again, giveaway every time I stream. My schedule is right here. You can catch me next week. Good luck in the markets, and I'll see you in the next video. So goodbye.
Hey stream viewers, if you're outside of the United States, I have a cool offer I want to tell you guys about thanks to our partnered broker, 8cap. 8cap is currently offering the ability for new depositors to get access to our premium tool, the EdgeFinder, completely for free. Now how this works is basically you create an account and deposit a certain amount of money into that account, and they will essentially buy the EdgeFinder on your behalf. So it's a win-win-win. They get a new client for a reputable brokerage, you get access to the EdgeFinder and a great brokerage to trade with, and you'll be supporting the show by signing up with 8cap. Now here are the steps if you want to find out more about this specific offer, but make sure to follow them specifically as we list them out on the screen here. Step 1, navigate to a1trading.com/8cap. That's a1trading.com/8cap. Step 2 is to follow the instructions and to make sure you use the specific link on that screen to sign up for your new 8cap account. Step 3, complete the required deposit amounts and contact their team as instructed on the page. So if you're interested in finding out more about this offer, head over to a1trading.com/8cap, and we'll also be dropping the link to this down below in the live stream chat as we speak. Like I said, make sure to follow those instructions specifically if you'd like to get access to a free copy of the EdgeFinder if you meet the deposit requirements as listed on the website. Full information, like I said, can be found a1trading.com/8cap. Now back to the stream.
Hello, hello. Happy Friday, ladies and gentlemen. How is everyone doing? Hope you're all well, hope you're all happy, and hope you have all had a profitable week. So, excuse me, I have reduced my exposure in the markets quite heavily over the past 12 hours or so. So I took a long on gold last night, closed it this morning for a roughly 1% gain, nothing too crazy. The New Zealand Swiss position was also closed around break even. We're still in euro pound, which continues to just move sideways. Absolutely nothing going on here. I'm just waiting to see if we can establish a, oops, hold on, that's not what I wanted to do. Just waiting to see if we can establish a bullish trend here with the moving averages, indicating obviously a trend change. Seeing if we can continue to run higher. However, so far, again, it's just sideways ranging, so it's very, very uneventful. The Euro New Zealand took this at the start of the week. Now, yesterday we did see some bullish pressure come into the market, so I decided to move the trade to break even because normally I wouldn't be that aggressive. Obviously, we've not really done too much, so it was quite an aggressive move in terms of management. The reason I did that is because we've still got quite a ways away from the 200 moving average. So even if we did come up for a mean reversion, it would have stopped me out. And the daily is still relatively oversold to a certain extent. Obviously, it depends on how you define oversold. But I would say this daily is a little bit stretched. So I just wanted to take an extra safe precaution on a Friday, trail the stop, and just let it run. If it hits stop break even, then fine, whatever. If it doesn't, then fantastic. Euro dollar, I'm still in this one. My scale in was stopped at break even. So I had a scale in, it was roughly around here. I decided to move it to break even yesterday evening or yesterday afternoon. It was sometime yesterday. That was hit, obviously. I allowed basically no room for the market to move. But I was just a little bit cautious. So, you know, better safe than sorry. But yeah, the initial position is still on the table, and gold is still, sorry, not gold, silver is still running after yesterday's drop. Saw quite a lot of freak out on social media, which I thought was quite amusing, to say that the move was actually kind of small, really, especially after what we saw. So at the end of January, I thought people would be a little bit more desensitized, but yeah, I guess not. Sluggy, hello, hope you're well. So moving forward, I'm still paying attention to yen pairs. Still, as I said yesterday, not looking to actually do anything. It's more just a case I'm just observing, just watching from the sidelines. I am still, cautious because I think we are on track for a rate hike by the BOJ at some point. We obviously got those intervention risks as well. So yeah, just not really too interested. So it seems like we're going to get the rate hike towards 1% or to 1%. I wouldn't imagine the BOJ going higher than that, but obviously that would cause a little bit of repositioning in the markets, especially if we do get some sort of hawkish tone. So I'm just flat. Moving forwards, Euro Aussie. I've been waiting for this one to pop up with an entry for a while. We do have a potential entry on the H4. I'm not going to take this because I don't like to place new trades on a Friday. Also, the daily is, in my opinion, quite oversold. It's very stretched here. So I do think we can come down to, oh, I keep doing that. hold on. I do think we can continue lower to correct this left side here. However, if we look at this daily time frame, we've just been melting to the downside. We've had no real pullback. So I really would like to see a pullback towards our moving averages, see this cross finish, and then I could get short again. I'm still very bullish on the Australian dollar. So I've got no issues with the trade idea itself. It's more just the price action. I'm not really very happy with it. Pound New Zealand is still on the table as well. I still really like this one, but again, it's just a case of waiting for a little bit of a deeper retracement on the daily. We've broken out of this 200 moving average, which is a great sign to say this bullish trend is broken. So it's just a case of waiting for the retest of, we've had the break, retest of previous structure and come into the fib level and then a continuation lower. That would also be a fantastic trade. But again, it's just a case of waiting. And then Pound New Zealand, again, what am I going to say? It's a case of waiting. There's really nothing on my radar right now in terms of trades that are ready to be taken. So with this one, exactly the same idea. Looking for this previous, it's not really even that major, but a little bit of support was formed here. We broke below, so I'm looking to see if we can get the retest into the fib value zone, also towards the 100 and 200 moving averages, and then again a continuation lower. Same thing with the Euro Australian that we were talking about. I do think we can come slightly lower just based on the price action, especially if we pay attention to the weekly right here. There's a lot of left side over here that I think maybe could get corrected, but of course we've got to deal with these weekly levels of support. So it's definitely not a trade I would just sit through the whole thing. It'd be more a case of doing what I've done so far, which is take the trade, take the profits, look for a re-entry and continue to just follow the waterfall, if that makes sense. Sorry guys, I'm not been reading the chat. Alan, nice background. Thank you, Alan. It doesn't compare to yours. I actually really like your background, but I appreciate it. It's always changing. Yeah, no, I moved my office around quite a lot. I'm actually in my girlfriend's office right now, so I've taken over hers. We're doing a little bit of swapsies. You have the same level marked up Pound New Zealand. Great stuff. How will you know if you're the winner of the funded account? I would assume you get an email. I'm not sure. I've got nothing to do with that, but I would guess you'll get an email from someone. Then we've got the Nikkei. This is pretty much the last thing that I'm watching. I really like the idea of being a buyer, but again, repeat after me, just a case of waiting. So we've obviously had this level of resistance. We've broken out, looking for the retest of this level into the fib value zone and then a continuation higher. The trend is really, really clean here. You can see 200 moving average rejection, rejections here, rejection here, rejection here. So I'm looking for basically just the same thing to repeat if we can come down lower. But yeah, right now, can't justify being a buyer because we've still got this aggressive sort of left side impulse that I do think we could see a correction of. New Zealand, US dollar. Let me just recheck this one. Yeah, so we're still getting this bullish reading with a score of 7. However, the price action isn't doing anything. You know, technically we are bullish with these moving averages, but we are just sideways. So there is nowhere for me to look to trade here. It's more a case of I would need to see a breakout of the high here, retest, and then continuation to the upside. Maybe if we come back down towards the 200, double bottom here, I wouldn't mind an aggressive entry, but that would be, I want to say worst case scenario, if that's like the backup idea if the ideal entry doesn't work out. But either way, I'm not a huge fan of that one. I'm still cautious regarding the dollar. So if we go to the weekly here, I'm not going to go over this. We've discussed this many times. I'm sure you're fully aware of this trend line. But yeah, I'm just a little bit wary of this. And we did get better labor market data, was it yesterday or the day before? But on the other hand, we had CPI come out a little bit cooler today. So we'll see what happens. NASDAQ. Yeah, we can take a look at NAS. Here. Yeah, so NASDAQ took a hit yesterday along with, wait, was this yesterday? Was it 4th? No, that wasn't yesterday, was it? Here was yesterday. My bad, forgot it was on the H4. So yeah, the markets yesterday did see a little bit of volatility come in, mainly just bearish pressure across the board. I mean, US markets were down, or US indices were down, metals were down. Yeah, it was quite eventful, but we've not really seen much go on here. So what I would want to see, ideally, is actually short signals. Now, I'm not going to go into why just yet because I'm still sort of building the idea. I don't want to give anyone a bias that might not work because being a short seller in these markets is very, very difficult. So let's just see, does the EdgeFinder have anything? No, neutral reading with a score of -2. So we've got pretty much nothing on the EdgeFinder. So automatically, I'm more wanting to just be on the sidelines. However, given the pressure, wouldn't surprise me if we could come down just slightly lower towards 24.45, roughly. Maybe retest this low down here at 24.192. Beyond that, I'm not too sure. So I think base case, and this is sort of default thinking, is just buy the low. So if we can come down and create a, what would this be, fourth, maybe fifth bottom, depending on how you look at it. Something like this could make sense. But again, I'm not really interested in doing that. But if you are someone that buys support, sells resistance, that might be an option. Didn't think the market would be this dry after a cool CPI print. Yeah, I mean, it seems like it was priced in, given that the market hasn't really shown much of it. It's because it's mixed, really. Yeah, New Zealand CAD. Let's have a look. Where's New Zealand CAD? Right here. I think this was getting a bullish reading at one point. Let me filter this actually because it's getting a little bit difficult to look at. So New Zealand CAD is getting a bullish reading of 6. However, I think we looked at this yesterday, and the conclusion that I came to was that it's basically the same as New Zealand US dollar in the sense that it's not doing anything. We've got the bullish trend technically with the moving averages, but the price action just isn't doing anything. So I can't really do anything on the back of that. You know, what can you really do inside this range? So as I said, as I said with New Zealand US dollar, it'd be a case of looking for the break and entering on a retest here. For now, this is just no man's land. There is nothing to do because if we get a break lower, it's very likely to introduce volatility, come and correct this left side. If we break above, that would line up with the EdgeFinder. I would be much more comfortable doing that. So yeah, we'll see. But for now, again, there's just nothing for me here. The Nasdaq's rolled over. Yeah, the Nasdaq's having a rough day. We've just had the market open almost 15 minutes ago. So yeah, we've had a pretty bearish open. But yeah, I mean, yeah, we'll see. I'm not bearish just yet, but there are reasons to be. So if we look here, I've shown this before, but I'll show it again. So let me get rid of the magnet. So these crashes often leave these highs. And when I say often, it's not like it's a continuously repeating pattern, but it's just one of those things that seems to happen that we could be looking for next. So like here during COVID, obviously we had the crash and then a complete correction. Then we pull back. We didn't obviously retest this level perfectly, but we did pull back towards it. Then we come back up and then we come back down again, retesting this level. And now we formed a new one here. So my thought process is at some point we might see the NASDAQ come down to around 22,000. Now, I'm not saying that's something to trade from. I'm not saying I am expecting that or I'm waiting for it, but well, maybe expecting it, but not something that I am actively taking trades off. Does that make sense? So it's something I'd wait for the signal, wait for the fundamentals to tell me that something has warranted selling US markets. Then I would look to sell the NASDAQ down to around 22,000. Hopefully that thought process came out clean or made sense because that was a bit of word vomit. Gold is so predictable. Let's see what's going on with gold. I've not checked it since I closed my position. Yeah, it seems to be doing quite well. However, I would say this is still a little bit of a cautionary zone. So actually, let me use a rectangle for that. Right here is presenting a little bit of a problem for me. So I was saying I think it was, yeah, probably earlier this week, maybe last week, that I do want to buy gold, but at the time price was around this level. I was just saying I couldn't justify being a buyer into this level of resistance, given that we've already had this really aggressive move down. We might still have a little bit of a negative sentiment there, some areas, sort of liquidity event, profit taking, whatever it may be. Just didn't feel comfortable with it. Now, I might be getting ready to be a buyer, and a bit more of a long-term buyer. So we are creating, give or take this trend line, it's not overly important, but we are creating these higher lows. And obviously we're creating this level of resistance. I don't trade flags or what are they called? What's this called? Does anyone know? Is it ascending triangle or whatever it's called? Anyway, whatever, it doesn't matter. I'm like 99% sure, if you look at all these technical analysis books, these generally lead to something like this, or that's the expected outcome. So given that we've got these higher lows, and again, we've got this level of resistance, it wouldn't surprise me if we do see a large amount of volatility come and correct this left side. Now, again, that might not happen, but I would rather be a buyer than a seller at the moment of gold. So that's kind of just what I'm waiting for. Why is my brush not working? Let's get rid of all that. So yeah, now if we zoom in a little bit on the H1, we've got the moving average cluster here, and we have got the level of previous support that could be seeing this sort of break and retest. So obviously, previous level, we've broken, we're now coming back up, and again, it could just be a retest before we come lower. And the thing to sort of back that up would be, if you trade moving averages, you've got the cluster right here as well. And the RSI is a little bit extended. So, doesn't, I don't care either way, it doesn't matter. But right now, what I'm trying to say is I'm just not ready to be in gold. I know that was a little bit of a long-winded way of saying that, but yeah, I've got no interest right now. Unless we do get that break above and the retest, and we get some clear bullish signs, such as gold increasing on the EdgeFinder, because we do have this bullish reading of 6, which again is supportive of being a buyer. So yeah, my hero, who, me? I would hope not. I'm not a very good hero to have. Happens very often. What happens, Sluggy? I think I might be a bit lost in this conversation. Ever since I took that Russell trade with Nick, I've been trading indices ever since. And it's been a great decision. Puts into perspective how slow FX can be. Yes, that's actually why I've started trading futures on the side, because I was scalping just on CFDs, but it was spreads and all that sort. It was just a bit messy. But yeah, if you're trading indices, I would take a look at futures. Honestly, I completely ignored futures for many years. Basically so far this year, I've been experimenting with them, and they're fantastic. They're really, really good, especially for scalpers. If you're swing trading, it doesn't make much of a difference, but yeah, for scalping, it's fantastic. But yeah, in terms of indices, they are quite easy to trade. Generally, obviously, that's a very blanket statement. I'm not saying trading is never easy, but generally speaking, they are a bit more easy than FX, because yes, you can get large volatility moves that do give you the same sort of R&R you would get with FX, but much quicker. But also, I mean, look, we drew that support in 5 seconds. So, it's just a case of really you would go in with a long bias by default, unless you've got a reason not to. Look for lows, supports, moving averages, just look for areas for bounces and just buy into it. Yeah, I mean, again, simplified massively, but I do agree that yes, indices are normally a little bit easier than FX. Same reason I started trading indices and everything under the sun, except corn and soybean. Yeah, I don't really touch agricultural commodities. I've traded a little bit here and there, but it's not something I would ever choose to trade. The reason I like FX is because, well, I guess maybe to me it's easier because that's just what I always have traded. But it's just a case really of, you've got three things in Forex really. I'm going to write this out because I've got about 10 minutes left, and I'll be honest, I've got nothing else to cover with you. So where's the text tool? Here. So you've got, what is it? We've got, let's say, jobs. So we've got labor market, you've got inflation and growth. And now, obviously, this isn't accounting for things like geopolitical events and black swans and things. This is just more of a general type of thing. And all of this is what feeds a central bank. And that's all we need to do. It really is that straightforward. Obviously, again, when you sort of simplify and dumb it down, that's how straightforward it can be. So the central bank is just fed by these three things. So all then you've got to do is look at what is the central bank's mandate or focus. So for example, right now, the Fed, we know that they held rates previously because of elevated inflation. Growth is looking okay. GDP's been coming out quite well. But then the labor market is what's been causing some problems, because we've had a sort of cooling labor market, or a not so great labor market, for lack of better terms. But then again, yesterday's NFP and unemployment rate came out quite well. So how does that feed into the policy? And today we just had inflation data. How is that going to feed it? Do you see what I'm saying? It's all just like, yeah. Again, I want to say simple. Of course, trading isn't simple, but you get what I'm saying. And that's kind of just how I've learned to trade. That's how I look at the markets in a nutshell. Whereas when I move to things like stocks and indices and agricultural commodities, that doesn't really apply. With indices, you could say it's the same thing with interest rates and hiking, cutting cycles, sure. But then I don't know anything about stocks and like earnings and those types of things. That's not something I've ever learned to do or paid any attention to. And the same thing with like supply and demand and weather patterns and weather forecasts and all that type of thing with like agriculture, like wheat, cocoa, and etc. So yeah, that's basically just why I stick to FX, because I know it a lot better than everything else, and I don't really see a point in moving. Anyway, I know that Markets Wizard traded soybeans and made dollars, but I don't understand the market, honestly. Yeah, that's the other thing. I mean, I've said this quite a few times, but I think in the markets that people don't trade, or let me be more clear, in the markets that people pay less attention, specifically retail, so things like corn, like exotics, exotics and emerging markets, there is more money to be made, I think. And it's not necessarily because the market's easier to trade, but even like the small factor, or maybe not small factor, but even like the factor of there's been less liquidity in those markets, the moves can be more volatile, meaning you can reach those profit targets a bit quicker, things like that. Anyway, we're kind of drifting off course here, but yeah, I think if you look at a lot of the traders who have made large amounts of money, I'm not talking about people that just make $1 million in a year. I'm talking about the real, like the serious traders, the real heavyweights. They're not trading things like Eurodollar, really. They're not trading things like Bitcoin. I mean, obviously there are whales in Bitcoin. What I'm saying is there's traders in history that are known for trading one thing. So, there's George Soros and the pound. There's the two brothers that cornered the silver market. I can't remember the names, but they dominated silver, and they forced COMEX to change the trading rules. And it's like, I don't really know where I'm going with that. But anyway, there you go. But yeah, no, in corn, things like that, I've got absolutely no idea. Not a clue. So that's that. Anyway, I think that's quite important as a trader, is to understand your limitations, because you can come into trade and say, oh, I'm going to trade everything that moves, blah blah blah. Anything that moves can make money, and theoretically, yeah, sure, but realistically, as Sluggy said, if you've got no understanding of that market, how are you ever going to navigate it with certainty and with precision? So there you go. George Soros and his 8th heart. Yeah, I heard something about that. Anyway, right. We've got 5 minutes left, so let's just do a quick review of Bitcoin. Now, I always say this, so do apologize if I sound like a broken record, but I don't trade Bitcoin, so take this very loosely. It's not something I really trade. It's more something I just like to look at sometimes. However, Bitcoin is at an interesting level here. So we've got previous highs, quite a major resistance that spanned from 2021 until 2024. We've broken out. Now we're coming back down into the same level, into this 200 weekly moving average. So the way I would look at this from a normal technical approach is actually this looks like a break and retest. So normally I'd actually be looking to be a buyer here. However, with Bitcoin, again, because it's not something I really trade, I'm a bit more cautious, and I wouldn't look to trade anyway. But what I've been looking at over the past couple of days, I would say, is just the previous market behavior. So obviously we rallied back here in 2017, then we had like, I think it was an 80% crash, rallied here, and then had, I think it was 76% crash here. Now I'm just thinking, is this the rally and then the next crash down towards, it could be 50, 40, 30, before we then have the next rally to the upside that could reach, 150, 200K potentially. That's what I'm worried about. So I was actually short Bitcoin, but I closed it at break even because it just wasn't really worth holding. The position size was so small. It's like, even if it did reach profit, it wouldn't have been worth holding anyway. It was just taking up extra portfolio space. But yeah, the fact that we've wicked down on this weekly candle and the current weekly candle isn't showing that much selling pressure, maybe we could see a bounce off here and then a continuation up towards 150. Who knows? We'll see. Hunt Brothers, that was it. Yes. Wait, what's it? I'm not sure. I can't remember the name, but yeah, I'll take your word for it. The Hunt Brothers. Yeah, that silver story was crazy. I like doing that actually. If you're interested in trading and like you really actually enjoy trading, go and look at there's a lot of videos on YouTube that go over all these great traders of history. Not even great, but like the big traders of history. Some of the stories are fascinating. It will give you like a whole different perspective on positioning, assets, allocations, and risk, and all types of things. It's really, really cool. Anyway, what could we pay any attention to? There's just nothing going on today. It seems like a very, very slow day. I'm sure lower time frames might be a little bit more hectic, but at least on the H4, there's just not really anything here. So there might be an entry coming for Monday or Tuesday on the pound Aussie here. I'm really liking this setup so far. We are pulling back quite nicely into the fib zone. As I said earlier, it would come and meet towards the 200 and the 100. It would be a very sort of typical mean reversion move within a trend, and then look for that continuation. So I'm going to set some alerts actually. Oh, hold on. Sorry, I've got my pen tool active. I didn't realize. So yeah, let me set an alert at 50%, and then I'll set another alert about 50% of the way into the fib, and another alert at the 61.8. And that way I can just be notified if we do get that pullback, and then I can come and do some reanalysis, if that's the word, or a refresh on the position. Yeah, Hunt Brothers, fantastic. So yeah, if you're bored this weekend, that would be my advice. Go and check out some of the great traders. Go and read their backstories, what they did, how they did it, that type of thing. Because I think what a lot of traders do, which is I think a mistake, is go to YouTube, they'll learn a strategy and they'll trade it, and that's it. But when you really study, and when I say study markets, I'm not talking about studying like all the mechanics of the markets really. I'm talking about studying how different people have navigated, because there's a million ways to make $1 million in the markets, but it's obviously not everything will work. So it's about looking at what's worked in history, how they found that, why they did it, how they did it, etc., etc. And it can really just bring another level into the way that you view the markets. It's weird. Anyway, ever since NFP, it's been a mess. Yeah, it's just like watching paint dry. Anyway, let me just do a quick check. Who's on after me, and then I'll hand it over because my time is coming to an end, unfortunately. As much as I do love sitting here talking to you about nonsense, we've got the great Alan Perez. Sorry, not Perez, Perez. Great Alan Perez coming on in one moment. Heard about the Chinese lunar holiday week. It could be impact market liquidity. I wouldn't expect so. No, I wouldn't say that's a big thing. For Asian markets, yes, but for general FX and US markets, no, it wouldn't be a big deal, I would assume. Okay, so last quick check. Silver actually isn't doing anything. I'm still sitting in these two positions. Euro dollar still sitting here, again, not really doing anything. Euro New Zealand is actually very likely to get stopped at break even, but I will let it run. And Euro pound still is doing absolutely nothing. So yeah, fun stuff. Ladies and gentlemen, yeah, I will head off. Enjoy your weekends. Have a great rest of your day. Stay safe. Don't get margin called. And don't go anywhere because Alan Perez is coming to take over the show. I'll see you very soon.
If you're enjoying the stream right now and would like to join us beyond just live streams, consider joining our free-to-join Telegram channel. Inside of our Telegram channel, we're sharing daily market analysis, bonus clips from the live streams and videos, giveaways to our products, prop firms, and brokerages, and much, much more. So like I said, if you're looking to stay up to date with ideas that we're looking at in markets, even if you can't make it to a live stream, consider joining our Telegram channel down below in the description of this live stream, or being dropped in the live stream chat as we speak. Just click that link, it'll navigate you over to Telegram, click join, and you can come back to the stream. It's totally free to join, and if it's easier for you, you can also just use the QR code that you see on the screen right now. Now back to the live stream.
Good morning, everyone. How's everyone doing today? Go ahead and join that Telegram channel like Nick just said. Free value here. I just dropped 2 new articles in there for you guys. Let's go ahead and talk about today's data, right? Because we did get some soft CPI, but you're not seeing the dollar decline, which is pretty odd. Actually, probably just as odd as why NFP came out super, super strong, and that was also no movement there, right? The traditional moves that we're seeing or that we expect from these releases is not happening. And I have an interesting take on it, right? So I think we had some couple data releases. We had some improving labor data. So we had unemployment come down. We had NFP tick up, which is a net positive. But then we also have the CPI report coming in softer, which is negative for the dollar. And I think it's actually a little bit of a trade-off, right? So you would usually expect a declining dollar on top of that. But I'm kind of thinking here, right, the moving parts between the dollar and what kind of moves currencies. And what comes to the back of my mind is the real yield, right? So this is the EdgeFinder's economic strength index, which measures the real yield. And so you have jobs doing fantastic, right? You have the interest rate staying flat, right? So assuming that there is no policy changes, no monetary policy, no rate changes coming until June, which is where markets are pricing in that. But with expected inflation coming in lower, that's actually positive for the real yield story in the US. And if you look at the US versus its other major peers like the Swiss, the Aussie, the yen, all of that good stuff, the US here at the very bottom in the blue is still at the very top of that list by a marginal rate. So you can actually see that there. And so that's why I think the dollar is somewhat supported, though you do have softer inflation. I think that's a good trade-off, that you get good jobs but softer inflation. And so the real yield story in the US does go ahead and improve until we start seeing markets pricing in some more aggressive rate cuts or policy shifts, all that good stuff. So I think for now, the dollar index is going to be pausing at this 96 handle here. Now, am I saying that it's going to, bump up dramatically? I don't know. It could fall. It could continue higher. I think markets are now expecting, or the next big data release when it comes to the inflation front will go ahead and be PCE, which is due. If I look at it here on the Financial Juice, PCE is coming in on the 20th, which is next Friday here. So that's actually when I move. So I'll be away from the table, but that's when, markets are expecting that next wave of inflation data. And I think, from there, markets will move. But for now, dollar is somewhat supportive. I'm in 2 positions, euro dollar short and dollar CAD long. They're still pretty much exactly where they were yesterday. So nothing much has changed on that front here. We'll see if this structure holds. I did kind of bet that the dollar was going to get some catch of a bid here. And so far, it's not really doing that. It's kind of just staying flat. So we'll monitor this position. But this is a 1-to-1 trade position. The idea is that any substantial bid in the dollar could get faded because, you still have the Fed to continue easing rates down the line. So I don't think that the dollar will go anywhere past this 105 level. I think that's a stretch even in itself. Maybe this 99 handle here, the 99.5 is a good level for resistance for the dollar. So that's kind of why I have the 1-to-1 trade here on the euro dollar. So basically trying to bet against any short-term dollar strength, and I'm looking to reposition once we get that, if we get that. The other position that I'm in is dollar CAD. Again, betting on some short-term dollar strength for dollar CAD here. However, I am kind of betting against oil. So oil has been this resistance level here that I've talked about before on the channel here. If you go to the weekly time frame, every single time that we've get to this level here in recent times, we've kind of faded off here. So you think of this once, twice, 3 times, 4 times, potentially 5 times. If you see the little hair of that wick here rejecting that level, and that's pretty much what I'm basing at. We did have crude inventories, all that good stuff. There's expected to be a significant surplus, similar to after COVID level, after 2020, when there was a ramp up in that. So production probably won't meet the supply, which is why I do think that oil can continue to fall lower. However, on a technical basis, I do think that this 61.5 level is a good support level if you just go ahead and put this here. And if I put my moving averages on here, this is the 200-day moving average as well, lining up right on this level of support. So it's pretty important. If you do get a little bit of flop here from this level of support, then perhaps oil just kind of just tumble lower, and that'll obviously help my dollar CAD position, because the Canadian economy, the exports rely heavily on oil. It's a big part of their economy, and so there's a correlation there when it comes to the Canadian dollar and oil. But so far, though, things are looking pretty good. I did get a message on Discord. Let me see if I pops up on my phone here. It could be something else. Nope. Okay, awesome. But yeah, that's pretty much my story with oil there. Again, dollar's pretty flat, not really changing too much, so I need to keep an eye on this. But yeah, also too, like the exports, like gold and all that stuff, that yesterday's decline, very, very fast decline in the metals market, does impact Canadian dollar as well. But yeah, that's pretty much what I'm looking at here. Again, super, super flat today. Depending on the movement, if it gets really slow and you see more data that's kind of counteractive my positioning, then I might just take it for a break even or small loss there. But pretty much that's how I'm positioned. If we look at the top setups page to see if anything has changed following the release, let's see. Go to top setups main page. Let me look at the chat. Yeah, heading towards Goldilocks zone. Yeah, that's also a thing as well. Dollar doesn't cost in the, or dollar doesn't drop in this case scenario. Yeah, Goldilocks is true. I think DXY will flatline into a solid catalyst. I believe so as well. I think PCE will be the next one. If I'm not mistaken, I do think that there will be a Fed speaker. I think it's Powell. I could be totally wrong, though, next week. Let's go ahead and see Japan, Australia, UK CPI, Eurozone. Not that I'm seeing, so maybe that was pushed off, or maybe I was just dead wrong in seeing that, which is a possibility in itself. But let's go ahead and look at the major currency pair. It's only here to see the top setups page. You do see the commodity currencies like New Zealand, Aussie doing pretty well here at bullish score. You have dollar CAD actually getting a -5 reading, which is actually not good for me. So I have to monitor that position closely. We'll see how things come up. We do have some Canadian data as well next week, so we'll see how that affects the score. But for now, I'm actually going against the grain here, so I need to be very, very careful. If anything, I can probably go ahead and trim my stop loss and make it a little bit tighter with dollar CAD. Maybe I can move it somewhere like this. So I'll go ahead and do that there. I'll put an alert to do so, or I'll put a note here on the side to do that, to change my USD CAD stop loss tighter. Cool. We'll go ahead and do that. But yeah, let's go ahead and look at so cool thing happened with the US, right? You have the US economic heat map basically showing the overall holistic view of the US economy. It was at 64 at one point. Now it's at 58. Again, we did have some exchange going on here with the US, right? You had some weaker growth, which is reflected in the retail sales. But then you have the unemployment rate tick out better. You had wage growth as well. Non-farm payrolls as well come out better than expected. So it was a trade-off, right? I don't think it's a net negative. I think it was a trade-off. And I think markets will take that any day. You'll take a better, who wouldn't? Who wouldn't take better employment figures for the exchange of lower inflation? That's fantastic. So I do think that the dollar will catch a little bit of support in that. Again, not the best support or not the most extreme support, but I do think it's support within itself. I'm curious about New Zealand dollar. Despite cutting from 5 to 2%, unemployment grew by a lot. It feels like RBNZ can't do anything. Another question, if central bank tools can't help, whose responsibility is it to improve jobs, and can we track this? For the most part, so like most central banks have their own metrics that they look for. They're pretty much the same categories, whether it be growth, inflation, and labor market. But like you see how the US has like a lot of data points to go after. New Zealand dollar, for example, not too much, right? So they're very limited, but they use basically the same categories for making their monetary policy. And so there's a nuance to it, right? Depending on their stage and like, you know, how big the economy is and things like that, or especially what's happening domestically too within the country, that'll definitely change the outlook for rates and how they're willing to move them and whatnot. Like for the US, for example, right? It's a unique situation. You had elevated inflation versus weakening jobs. And so the Fed was saying verbally that they were going to target the job market first, go ahead and save it. And basically, they were making their monetary policy decisions based on that. So the labor data was very, very sensitive. Anything relating to NFP, ADP, unemployment rate, all that good stuff was more sensitive than you would, for example, retail sales, right? So, but let's say that the landscape shifted a bit. We had super strong labor data, all that good stuff, and the only one that was really weakening was growth or something like that. Then you have like recession risk. So then monetary policy shifts towards more of that direction. So it depends on the individual, like what's going on in that economy, for example. Yeah, most time though, people sit on their hands, like Sluggy said. So when it comes to interest rates and stuff like that, it's a lot harder to go back on what you did versus just being on wait and see mode, right? You can always wait and see, but reversing a big shift like in interest rates and stuff like that is much harder. So for the most part, most people take the approach of just waiting and see and letting the thing fizzle out, play out, and then go from there. Let's see what we can look at here. As far as new setups goes, I know a lot of you guys like to look at other asset classes as well. So gold, right? Gold basically had a humongous drop yesterday, but then has pretty much recovered since then. Most of the drops that it did yesterday. So let's go ahead and see what gold is doing here. My personal opinion, I would wait for a steeper pullback if I do want to participate in gold. I think the landscape still favors gold, right? But I think chasing price at these somewhat elevated levels relative to where we've been at in the past, maybe not the smartest idea. So if I was a gold trader, I would wait for that 4,700 level as the next level of support here. If we do hit that, maybe we do make more of like these higher highs, higher lows in the microstructure following this big drop here. So this is a, higher low. Maybe we get something here, higher low as well, and then you can trade it to the upside. But for now, chasing price here, I wouldn't do it. I wouldn't also short gold either, just because you can always get some kind of a flare up in geopolitical tensions and all that good stuff, which will definitely make gold very, very attractive. So I wouldn't really play gold like that as well. So I would be more patient, waiting for gold to get a retracement here. Now, if 4,700 fails and you get 4,400, I would take that too all day long. But for most part, I think the path of least resistance for gold is just some choppiness here and maybe a slow grind lower. But we'll see how that plays out, because we did have some very interesting price action yesterday. And so if that continues, then we can get there a lot sooner than we probably think. As far as silver goes, silver was the more memeified metal of the two. This thing is showing some very relative weakness compared to gold, right? So I think gold is the more established, safer option. Silver too, unless you get like a very crazy flash crash drop where you get a very discounted level, then I think it'd be wise to buy silver. But until then, I'm kind of just staying away from it here. We've talked about this before on the live stream here, but when you look at some historical data here, every time you get a flash run up here in silver, the returns following that is not very attractive. It's actually hard to navigate that price action. So I'm assuming the same thing is going to happen if history repeats itself, or not repeats itself, but history does tend to rhyme sometimes. So I really wouldn't participate in any long silver, just considering the past, right? And I made a post there on the A1 Trading Instagram, but essentially what happens is when you see silver drop 20% or more from its all-time highs, the forward-looking returns are pretty much flat or non-existent. So I think that's probably going to be the case here for silver as well. So it may be hard. You may get these low flare-ups here, but I think ultimately the returns are going to flatline and you might see a little bit of a slow grind. And you just don't want to participate in price action like that. There's better assets to go ahead and participate in. You have FX, which has been somewhat decent in the past. You have equities as well, probably presenting some buying opportunities, especially if you get this level of support here folding, this 6750 level. If this 6750 level tends to fold, then 6500 will be a fantastic level. That get that 200-day moving average there. Would it suck? yes, but if you're prepared, if you're not currently in the equities market, maybe you can put some money on the side or be on standby and wait for something like that to happen. You can also take that 67.50 level as we kind of held it last time. But again, you always want to wait for the better opportunity if you can. Same thing with NASDAQ as well. Pretty close to that 200-day moving average. So another good level of support. Now, if this thing does fold, then you do have a lot of downside risk to kind of look out for. So if this 200-day moving average folds over here, you got the next level, which is the one I think, which is 22,000. That's about a 9% drop here. So could happen pretty fast, could be ugly in the time, but when you get those flash crashes, those are where you have the best opportunities, especially when you have sentiment getting super, super scary, all that good stuff. And what that would look like, right? One of the things I'm preparing for personally, if you do get something like that, I'll probably be looking at some sentiment data, definitely the put to call ratio, which is pretty much a very, very good timing tool when it comes to getting on the right side of these very erratic moves. So where is the put to call ratio on this thing? Just for an example, guys, you want to take the put to call ratio and use it to your advantage when you get these very polarizing sentiment. Was it moved around a little bit? I don't know. Okay, let me go ahead and crowd sentiment. That's where it's going to be. Put to call ratio. Yeah. So let's look at the put to call ratio here for the S&P. It was a little bit high there, high put volume, and it's now kind of faded back towards the upper end of this channel here, where it's usually within the range. So nothing too crazy there, but the put to call ratio is something that you very much want to consider if we do get a flash crash. So what I would do is, like, if you see the S&P 500 way down here, for example, right, maybe 6,500, and you see this thing with high put volume, that would be a great sign for me to go ahead and take the opposite side of that trade. So something very, very much to consider. Speaking of crowd sentiment, let's go ahead and just look at retail sentiment just for fun here. And we'll do the major currencies only, just so I can see what's going on. Okay, let's see what the crowd is doing. So we have heavily short positioned in the Aussie dollar and the Euro dollar as well. Most of these are flat here. So dollar yen, dollar CAD, pound, pretty flat. Dollar Swiss, super, super long positioning here. So usually you want to take the, well, it depends. You can take the contrarian signal or you can trade with this. Let's look at the metals, which is, I'm sure everyone's interested in that as well. Let's see. Super. Oh, wow. Look at this. Look at this divergence here. You have 89%, almost 90% of retail crowd long silver and 95% of the crowd short gold. Very interesting. Very interesting. And you are seeing some divergence in the price action as well. You see the gold somewhat elevated relative to silver. Interesting to see that for sure. I find it weird that ADP showed 22K jobs added in November while NFP was 130K. I wonder which one is accurate. NFP is the one that's mostly looked at. ADP has faced its scrutiny in the past. So usually people focus on the NFP report, I would say. Looking at yields, though, the 30-year, the longer end of the curve is dropping here, which is bad for the dollar. So usually lower yields indicate a weaker dollar. The 10-year yield, wow, look at the 10-year has made some significant progress to the downside. This is actually good to see, actually. 2-year yield as well. I remember it was elevated a couple of days ago. Now it's kind of fading off too. So the yield story in the dollar is actually fading a little bit. So you should see some kind of a dollar bearishness. But again, we're not seeing that yet. So we'll see if that is a lagging effect or there's some divergence there that we got to be watching out for. As far as global yields, though, the Aussie dollar yields are back to where they were before this crazy pop here. So Aussie yields lower. New Zealand 10-year yield also kind of just hanging out within its range there. Euro yields are kind of falling a little bit here relative to recent prices. Again, the yen yields are somewhat elevated here, and that's probably you're seeing that trickle into the whole crypto story. Now, Bitcoin is up 3% today, but if you look at 3% and consider the overall price action that we've been seeing, not the biggest improvement there. So my thoughts on crypto, I know we talked about it. I know it's been a hot topic here. And I know I may sound like a broken record, but I think the path of least resistance for crypto is going to be towards that 50,000 level because I do think that we are experiencing a global rate hike. Now, it's happening a little bit slower than usual or than we would probably think, But I think that the overall dynamic is that Japan with their rates and everything like that the effect is of a global rate hike, and so I do think that has some negative pressures on Bitcoin. So I think 50,000 would be a good level of support. Just looking at this from technically speaking, I'm not a crypto trader, I'm not a crypto expert. That is just my thoughts. If we roll over from 50,000, then I do think we have more worries to look out for there. But so far, I think crypto is kind of just having that crypto winter that most people say, and it sucks. But I think it's healthy for markets that when they act super euphoric and they move heavily, that it's very natural for corrections, for leverage unwinds, things of that nature. And so this recent decline here, although I'm sure has been very painful for most people, it's healthy to see that. And so I think what happens is a lot of bad actors or people that were probably taking the wrong approach to crypto are getting wiped out, and so you have some kind of a stabilization after this. So just my thoughts on crypto. If we get a revision on which we could easily see made up, yeah, you could also see revisions as well for any of these data points, and that's where markets really tend to move. Yeah, funny thing, reaction is no reaction on NFP and no reaction on CPI. I agree, man. The NFP too, because the NFP was the first one of the two, and so with the CPI print today, you were like kind of thinking like, well, maybe is CPI going to act the same? But with NFP, definitely. I mean, it was a stellar jobs number. It was almost double what was expected, and you had a very muted reaction. And with the CPI as well, it wasn't that crazy of a beat, but still, nonetheless, it was an expectation beat, and the reaction is somewhat muted. So I'm curious to know. There's a lot of underlying factors going to that, but my personal opinion is that DXY catches a little bit of a bump, and then I'm looking to fade that any chance I get. Maybe when we get to these moving averages here, the 200-day and the 50-day, as they're kind of hanging out here. So that will be a good level. In fact, I'm going to mark this up on my chart. I like this level here, something like this. This will be good. And this basically translates to my euro dollar position. This like little target that I'm kind of aiming for here on the euro dollar. This looks pretty much the same. So if I mark this up here, you can see that the price action, like the DXY and the euro dollar, are pretty much inverse, because the euro dollar makes up most of that DXY basket. So that's pretty much what I'm looking for as far as euro dollar. Again, meeting up with the 50-day and 200-day moving averages, same to the dollar index. So kind of what I'm playing for, but we'll see. There's a possible chance that PCE next week comes out super cool, and this thing just falls off a cliff. Very, very possible. Guys, don't leave any open trades without stop loss on gold and silver. Manipulation can happen. I don't think so much manipulation. I think markets just react to what markets react to. There's every headline or whatever that comes onto the tape has an implication to it, and those implications are what ultimately gets priced in. So I don't think it's much of a manipulation, but I do agree with you that you should have a stop loss, not only on gold and silver, but on every position that you have. You should always have defined risk. That way you're not surprised. And you should always accept that defined risk. That way you're not, pulling your hair out at night and all that good stuff. I think we've all been there, where, especially in the early parts of your trading, where you're trying to make money, and trading is not for making money. It's for taking calculated risk and, slowly growing capital. So as long as you take that approach, you're going to be in a good spot. But yeah, definitely have a stop loss on every single asset that you trade, and trade with a smaller size that they can hold on to. The good thing is my DXY short positions are all they break even. So if they stop out, then it is what it is. Move on. Perfect mindset. That's like the best. That's the best thing about when you trade with your rules and everything like that. You already know the outcomes. You already know the worst case scenario, the best case scenario. And in your case, off main, your worst case scenario is that you just break even, which is a fantastic position to be in. So that's awesome, man. DXY short, were you shorting? I'm curious to know what asset you were shorting DXY. Let's go ahead and look at Aussie dollar here, which was a monster trade, one I've been very adamant about. However, I've just missed it on many occasions. I had one chance to go long Aussie dollar where I actually participated. I got in for a profit, but again, I was trailed out with this recent dip here. But nonetheless, Aussie dollar, strong trade here. I think it still has some room to go. but I do think that we are also reaching a level of resistance here that we've reacted to in the past. And so I do think that we get some kind of a pivot lower here. And if we do see that dollar strength and this Aussie dollar weakness here, I'm super open to getting back into this level of what was once resistance, could probably act as support. So if I draw this out here, just so you guys know, this is something that is on my mind. And I have an alert here. As you see this white line here, this is an alert. But if we get a dip here in the Aussie dollar, I'd be very open to see what the price action looks like if it's reactive to this zone here and then trading it higher. You do have elevated inflation in the Australian economy. You also have the Fed that is looking to go ahead and lower their interest rates any chance they get. You do have actually, before the CPI release today, you did have 2 rate cuts on the table. Now you have 2.5. So a very slight increase in rate expectations for cuts. However, nonetheless, the Fed is still trying to go down the path of lowering rates. So that too, divergence there between policy, Aussie trying to raise the rates, US trying to lower the rates, is fantastic. That is definitely fuel for this thing to continue higher. I'm just going to wait for that pullback opportunity. That's what my swing trading looks like in a nutshell. Break even loss, then a winner happens and takes care of everything. Exactly. Like James was saying, I was listening to his segment on the show, and most of like the bigger traders that are having like these massive winners, or any just professional trader that's been in the game for long enough, most of their P&L comes from a handful of positions every year. So most of the year is just about surviving, getting through it, taking your base hits, and then every once in a while, every year or so, the market will present a very obvious, just big trade. And if you're present, if you're in the moment, you can go ahead and take advantage of that. And that right there in itself will take care of most of the year's P&L, just in that one isolated, environment, that time frame. I started day trading yesterday with a $10,000 account, and today I made $183 today on the S&P 500. Do you have any tips for me? If you're trading futures and all that good stuff, S&P 500 is a good asset to do so. What I would recommend on a $10,000 account, though, is take it slow and steady. I don't know if it's a prop account or a live account, but whichever way it is, trade it responsibly. With $10,000, you're probably not going to make a killing. I'll be very honest with you. You're not, but treat it wise, and it'll slowly compound, and it'll take longer than you think. And there's a lot of things that you're going to learn, but it's a fun ride if you love markets, if you love learning about it, if you can stomach the annoyances of it, like break evens or slow months and all that good stuff, then you'll be fine, man. My only advice is be careful on the leverage. That's literally all I would say. Be careful on the leverage. If you can, if you like literally started yesterday, then use no leverage at all for like the first 3 months at least. Cycling, would I be considering trading breakouts? Of course, man. Of course. So one thing, there's a caveat. So with breakouts, there's a difference between a breakout and chasing price action, right? Chasing price action would be like you're just blindly trying to catch you're getting FOMO basically, right? Now a breakout is super good. So investors are like buy low, sell high. With traders are buy high and sell even higher, or sell lower and sell even lower. So I think that's the case with breakouts, right? As long as you are seeing some very from a technical analyst perspective, a clear break and retest of like actual structural support, then I think that's super advisable, I would say. So if you get a breakout of the 7,200 here on the Aussie dollar, you go higher and then you come back here and this is clearly holding, then yes, you're just following the trend. You're following momentum. You're just following later than you would have liked. But nonetheless, as long as you have stop loss in place and all that good stuff, I think it's still good grounds to go ahead and trade the Aussie dollar. Ideally, cycling, I would like the pullback just so I can be at a better price. I would rather be filled at 6,900 than 7,200. Who wouldn't? But yeah, definitely. If you see that breakout structure happen, then I would definitely go ahead and participate that way. That's definitely a possibility. One thing I would say, guys, we do have the EdgeFinder for free. This is the last day to do so. I would definitely recommend everybody go into just sign up for it. You can do it by joining the Telegram channel. If you can drop the link into this in the chat here, James. I don't have it on my clipboard here, but join the Telegram channel. It is completely free value. You get 2 chart markups every single day. You have a closing bell question, like a quiz, if you will. And you also have right here where you can sign up for the free access for the EdgeFinder. Completely free. Go ahead and play around with it. There's so many tools at your disposal that you can look at. And then definitely copy you guys a copy next week, right? Once the sale ends or the trial ends, consider buying the EdgeFinder. I promise it will help your trading. If you buy the EdgeFinder and then watch the Telegram channel and also watch the live streams, I promise you that you will improve your trading. And that goes for you, Shap. If you just started trading, go ahead and get yourself a copy of the EdgeFinder, and everyone else here too listening. But with that, I will leave you guys. Happy Friday. Enjoy your weekend. Have a blessed rest of your day. And like always, trade safely, everyone. Bye-bye.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.